Welcome to vTalkInsight, Risk Sentiment Daily for February 24th, 2026. After a string of calmer sessions, risk appetite has flipped decisively as tariff shocks, credit stress, and geopolitics collide just as central bank and earnings narratives hit an inflection point. Risk sentiment has swung back to a clearly risk-off posture. In the latest session, U.S. equities fell just over 1% on the S&P 500, with small caps down closer to 2% and about 70% of large cap stocks finishing lower. Volatility edged higher, with the VIX pushing back above 21, while defensive sectors such as consumer staples, healthcare, utilities, energy, and real estate outperformed more cyclical areas. Cross-asset signals echo that defensive shift. Yields on U.S. Treasuries moved lower by around 4 to 5 basis points on the 10- and 2-year points, and gold is rallying toward record highs, having gained roughly 6% over 4 sessions and now trading above $5,000 an ounce. The U.S. dollar has weakened broadly even as risk assets sell off, with the euro and several Asian currencies stronger, reflecting both policy uncertainty and increased U.S. investor flows into overseas assets. Leadership is rotating away from last year's tech winners toward defensives, while pockets of stress in private credit, apparel retail, and European technology add to the de-risking tone. This marks a clear deterioration from the more cautiously risk-on tone seen late last week, when the rollback of emergency tariffs and strong AI capex helped support equities. Today, three forces are dominating the downside narrative: an abrupt escalation in U.S. tariff policy and legal uncertainty around future refunds, mounting liquidity stress in private credit and private equity, and persistent geopolitical tensions centered on Iran and European energy routes. Set against that, expectations for central bank rate cuts, resilient manufacturing and freight data, and continued flows into international markets offer some medium-term support, but for now the balance of risks is firmly skewed toward defense. Escalating and uncertain U.S. tariff policy is the single biggest driver of the current risk-off move. After the Supreme Court struck down the administration's previous tariff authority, the White House has moved quickly to impose a 15% levy using Section 122, up from 10%, but only for 150 days unless Congress acts. These new measures are global rather than country-specific, have already seen multiple rate tweaks in a span of roughly 36 hours, and sit on legally fragile ground, leaving corporates and trading partners guessing about the rules of the game. The legal and administrative backdrop is equally murky. A recent Supreme Court ruling on earlier tariffs has opened the door to as much as $170 billion in potential refunds to U.S. importers, but further litigation is expected and companies such as Costco and Alcoa are delaying claims as they wait for clarity. Estimates suggest that the legitimacy of current tariffs could be challenged for 3 to 4 years through multiple court levels, and research from the Federal Reserve indicates that up to 90% of tariff costs have been borne by U.S. firms and consumers rather than foreign exporters. This uncertainty is feeding directly into earnings and sector performance. Apparel retailers like Gap, Abercrombie & Fitch, and American Eagle report net margin hits of 100 to 225 basis points from earlier tariffs, while the latest adjustment from 10 to 15% looks set to deliver only marginal relief of 20 to 50 basis points. Names such as VF Corp, Nike, and On Holding are under pressure as hopes for quick refund windfalls fade. Politically, the stakes are high. Congressional budget estimates show that if 15% tariffs are not extended beyond 150 days, 10-year revenue could fall by about $300 billion versus prior projections, yet there is little appetite in Congress to reclaim tariff authority in an election year. Markets are therefore staring at a volatile mix of executive discretion, legal challenge, and potential ad hoc consumer rebates as fiscal stimulus, which together keep trade policy a live overhang for risk assets. Private credit and PE liquidity stress is the second major bearish driver weighing on sentiment. Private equity firms are sitting on around $3.8 trillion of unsold assets, with distributions to investors at their second lowest level since 2008 despite a 44% rise in deal value last year. That points to a model under strain, where exits are difficult and dry powder remains stubbornly high. In parallel, private credit is showing its own cracks. Blue Owl has frozen a $1.6 billion private credit fund and sold assets to meet redemptions, while other vehicles, such as OBDC2, are planning to return up to half of investor capital through asset sales. Public markets are reacting to these stresses. Listed private equity stocks have sold off sharply, with some names down 7 to 8%, and major banks exposed to the space, including Citi, have dropped around 5%. There is a growing sentiment gap. Alternative asset managers highlight solid portfolio fundamentals, but their investors are increasingly focused on potential defaults and structural risks over the next 6 to 12 months. This divergence has turned liquidity management in alternatives into a systemic talking point, even if stress is still concentrated in certain retail-oriented funds rather than the core of the banking system. The implications for risk sentiment are significant. If private credit funds continue to gate redemptions and sell assets to raise cash, financing conditions for mid-sized companies could tighten, especially for those that depend on non-bank lenders. At the same time, lower distributions from private equity reduce cash flowing back to institutional and high-net-worth investors, potentially dampening appetite for other risk assets. For now, this is reinforcing a broader preference for liquidity and simplicity, adding another layer of caution on top of tariff uncertainty and geopolitical risk. Geopolitical tensions and energy supply risks remain a third important headwind for risk assets. The U.S. has assembled its largest military presence in the Middle East since 2003, with multiple reports pointing to preparations for potential strikes against Iran if nuclear talks in Geneva fail to deliver progress. A temporary closure of the Strait of Hormuz, through which roughly 20 million barrels a day flow, would trigger a sharp spike in oil prices and volatility across energy-exposed assets. At the same time, analysts note that a prolonged blockage is unlikely, given the severe economic damage it would inflict on exporters such as Saudi Arabia and the UAE and on large importers like China and India. Europe is dealing with its own set of vulnerabilities. Hungary is threatening to block key European Union decisions on Ukraine, including a large loan package, until Russian oil shipments via the Druzhba pipeline resume, underscoring how exposed parts of Europe remain to disruptions in Russian supply and infrastructure attacks. Meanwhile, internal instability and declining legitimacy within Iran create additional tail risks, from refugee flows to potential fragmentation, that could unsettle neighboring markets and energy trade. Despite all of this, oil prices are currently capped by a sizable global oversupply and more than 4 million barrels per day of OPEC plus spare capacity, leading some forecasters to expect Brent to average in the low 60s even with a roughly $10 risk premium. Market behavior reflects this uneasy balance. Gold has regained strong momentum and is being bid as a geopolitical hedge, while safe haven demand for treasuries has increased, even as oil prices themselves have been surprisingly subdued on days when tensions rise. Bitcoin, despite positive structural developments, is under pressure as its risk asset characteristics dominate in a risk-off tape. Investors will be watching the early March deadline for Iranian concessions, the progress of U.S.-Iran talks, and any new disruptions to European energy flows as key markers for whether this risk premium stabilizes or flares up again. Against this risk-off backdrop, growing expectations for central bank cuts offer one of the main medium-term supports for asset prices. In the U.S., market pricing increasingly reflects a binary outcome, either multiple Federal Reserve cuts later this year or none at all. Some participants argue that investors are still underestimating the scope for easing, highlighting rising job market uncertainty and the possibility of up to 3 cuts by September. Fed Governor Waller has kept the near-term path open, stressing that upcoming labor data will determine whether policy is paused or eased, and yields above 4% on the 10-year are not widely viewed as expensive, helping explain why treasuries have rallied only modestly despite the risk-off tone. In Europe, FX dynamics are feeding directly into the policy debate. A weaker U.S. dollar is broadly seen as consistent with Washington's long-run reshoring agenda, while euro strength is causing growing unease within the European Central Bank. If the euro were to appreciate past 1.20 against the dollar and stay there, the likelihood of a rate cut in the eurozone later in the year rises, according to multiple observers. Taken together, Fed and ECB communication points to an eventual easing bias on both sides of the Atlantic, which, once the current bout of tariff and credit anxiety is better priced, could help stabilize duration and selectively support rate-sensitive assets. Resilient growth and sectoral supply strength are another counterweight to the prevailing gloom. Recent U.S. GDP data showed a drag of about 1.15 percentage points from government activity, but forecasters expect that to reverse, with some projecting growth around 3% this quarter. Beneath soft headline numbers, core factory orders and durable goods, excluding transportation, have posted their strongest gains since mid-2024, and core capital goods orders and shipments are rising, suggesting a healthier underlying manufacturing pulse than the headlines imply. Real economy indicators echo that resilience. Industrial freight demand is improving faster than retail and e-commerce, helped by new home construction and data center builds, while structural driver shortages and regulatory shifts are expected to remove 20 to 25% of trucking capacity over time. Spot trucking rates already sit 15 to 20% above contract levels, supporting margins for brokers. In North America's metals and mining sector, confidence is robust thanks to strong demand for critical minerals needed for AI infrastructure and supply chain shifts. Policy interventions, including potential government equity stakes in mining projects, are generally viewed as supportive, providing investment certainty and reinforcing the medium-term growth outlook in these niches. Finally, there is a clear rotation toward international and European assets playing out beneath the risk-off surface. Broad-based dollar weakness, alongside strength in the euro and several Asian currencies, is being driven not only by tariff and policy uncertainty, but also by growing U.S. investor allocations to overseas markets. In January, flows into non-U.S. exchange-traded funds surpassed those into U.S.-focused vehicles, and if U.S. equities underperform while the dollar continues to drift lower without triggering a broader volatility spike, international markets, particularly Europe, could become relative outperformers. European equity dynamics underline how differentiated the opportunity set has become. Headline indices have been flat to mildly negative, but single-stock dispersion is at record highs, with AI-enabled winners in capital goods and renewables crowded, while disrupted sectors and exporters lag. Utilities and banks have recently outperformed even as technology and industrial names like SAP and ASML sell off, and exporters have seen earnings expectations cut by around 7% over the past year, largely because of euro strength. For globally diversified portfolios, that combination of FX trends, capital flows, and dispersion suggests that international allocation decisions and stock selection may matter more for returns than broad regional calls, even in an environment dominated by tariffs and geopolitical risk. To sum up, risk sentiment is decisively risk-off, driven by an abrupt escalation in U.S. tariff policy, mounting liquidity stress in private credit and private equity, and persistent geopolitical tensions that keep a risk premium embedded in energy and safe havens. At the same time, growing expectations for central bank rate cuts, resilient pockets of growth in manufacturing, freight and critical minerals, and a steady rotation toward international and European assets are preventing a more disorderly unwind and could shape how markets recalibrate once the immediate shocks are digested. Key things to watch now include the legal and political path of U.S. tariffs, further developments in private credit fund liquidity, the trajectory of U.S.-Iran talks, and upcoming macro and earnings data that will inform the policy path. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.